Rohr here with an early global view on Wednesday, July 29th, 2015. It's currently 7 a.m. U.S. Central Time, and it's wonderful Wednesday FOMC statement day, and the influence is being seen in the markets in the form of the equities being up, but the govies not really particularly suffering. There's some critical thresholds we'll be discussing very shortly. But first, to the macro view. So let's take a look at what all this means to the markets. And quite frankly, we've got a nice rebound yesterday, and we think this was in part on the sort of bad news is good news psychology insofar as the markets were interpreting that the weak news was going to leave the Fed statement today, statement only, no projection revisions, no press conference, the Fed statement today sounding a bit more accommodative than it might have otherwise, and with good reason. The Fed probably is not in a hurry to raise rates while there are problems with the other economies. And what we see on the hourly chart of the S&P on the left, 30-minute on the right, is that after the knock the market took out of the late part of last week into Monday, that it basically held down around the low end of 2060 to 2056, spent some time down there, but by early in the morning yesterday was starting to push back up and ultimately broke back up above 2067 out of its current aggressive downward channel, and now is back up for the close yesterday, up at testing the low end of 2088 to 90. But this morning it's already up $5 at 2092, and that's important because above 2088 to 90 it just might go for the retest of 2096 to 2100. And as you can see, going back to last Thursday, although quietly at mid-session at first, this market is actually on a fresh down break from right around 2100 once again. So this significant area we're going to look at again on the intermediate term charts is a big key. If it's back above 2100, you noted how last time it was able to range up to the 2119 to 25 failed up break from back in May. And if it can't get above 2100, it's likely to come back under pressure. And then we'll see what happens back to this other key zone, 2078 to 75, which has been a significant resistance on the rallies going back to earlier this month when it's after it slipped below it in late June. And we'll see more of that on the intermediate term charts as well. But for right now, what we have to note is that if it is continuing higher today, the hourly MACD will join the 30-minute MACD in being out above its upper runaway band, and classically that is grounds to feel that the market can continue to work its way higher in the near term, probably into and somewhat after the Fed until we see what goes on with the GDP tomorrow. That's pretty much it for the short-term view of the S&P 500.